Growth in the ETF industry has definitely been dominated by a few of the major players, particularly over the last 5 to 10 years. So the idea from a sort of niche perspective or a new entrant into the ETF arena, really growth comes from a couple of different places. It helps to have a couple of things. One, a good niche, and one, good product. You know, the fact of the matter is that, you know, these days there's 1,300 ETF products or more in the US. You know, obviously, you know, asset growth has been, you know, extraordinarily, particularly in the last 5 years, but just the sheer number of products have grown dramatically along with the number of people providing those products. So it really starts with, do you have a product, do you have an investment strategy that is valuable to the client base? So again, from our perspective, the alternative, the liquid alternative investment space, providing alternative investment strategies in the ETF wrapper, in the state-of-the-art wrapper that is the ETF wrapper, really has helped drive growth for us. That's the type of sort of niche that new entrants into the marketplace are looking for to compete with the big three, who are obviously covering the world from just a core position perspective. Leveraged ETFs, or geared ETFs as we call them, first and foremost are risk management tools. So we have a wide variety of investors that are using these tools: institutional or professional money managers, registered investment advisors, people that are looking to manage risk in their portfolio. The fact of the matter is that, you know, levered and inverse ETFs are not for every investor out there. They take a certain amount of sophistication and education in order to use the tools properly. But again, the folks who are willing to dedicate that time and energy to actually understanding how the products work and how they can fit into the portfolio, they are seeing a lot of value with using them as risk management tools to help protect their client portfolios. Particularly right now, in the environment that we're seeing from a macroeconomic perspective, over the course of the last year, more and more investors have become worried about rising interest rates and what that effect will have on their underlying bond portfolio. So we've seen a lot of people using and gravitating towards our inverse fixed income product lineup to help protect their overall bond portfolio in a rising rate environment, because as you know, as rates rise, bond prices fall.